Good afternoon, everyone. My name is Lauren Israelovich. I'm a staff attorney with New York Legal Assistance Group's Foreclosure Prevention Project. Today, I will be providing a brief overview of mortgage lending and servicing, with a particular focus on prevention strategies for homeowners struggling to make their mortgage payments. You will learn about President Obama's federal Making Home Affordable Modification program and whether you might qualify. Also, you will learn what to expect in a foreclosure proceeding and what actions a homeowner should take to prevent or delay a foreclosure sale. If anybody is having trouble hearing me, please just type into the box and I will try and fix whatever problem there may be. Before we begin, please note that the information contained herein is for informational purposes only and is not legal advice or a substitute for legal counsel, nor does it constitute advertising or a solicitation. The information provided during this presentation is of a general nature and is not intended to provide legal advice concerning any specific situation. In order to obtain legal advice concerning your situation, please consult an attorney. NILAG attorneys are available for free legal consultations through UJA Federation's Connect-to-Care program. I will be providing the phone number at the end of this presentation. Please also note that I am only barred in the state of New York, and the information provided in this presentation focuses on New York law. Legal issues are drastically different across the country. At certain points, I will discuss federal mortgage programs and laws, which are the same regardless of where you reside. I will point out when I am discussing such federal programs and laws. If anyone has specific questions, please do not hesitate to send them during the presentation. I will leave time to answer all questions at the end of the presentation. To begin, let's go through the different elements of a mortgage note, which consists of the principal, the interest rate, the term, and the monthly payment. It's important to first distinguish between a mortgage note and a mortgage contract. A mortgage note is the borrower's IOU to the lender. It's a contract between the borrower and the lender that contains all of the terms of the loan, for instance, the term, the interest rate, and the monthly principal and interest payment. The mortgage contract, by contrast, is a contract in which everyone who is listed on the deed to the property agrees to give the lender a security interest in that property. The mortgage contract states that if the borrower defaults on the loan, then the lender can start foreclosure proceedings to seize the property. In New York City, you can view mortgage contracts and mortgage assignments online on a website called ACRIS. That's spelled ACRIS. However, mortgage notes are not available on ACRIS, and this is to protect the privacy of borrowers. The principal is the total amount that's borrowed. The principal balance is the amount that's yet to be paid on the original amount borrowed. The interest rate is the cost of borrowing money over time as a percentage of the principal balance. The interest rate may be fixed or adjustable. The term is the amount of time that the borrower has to repay the loan. The norm is 30 years. The monthly payment goes toward both principal and interest unless a borrower has an interest-only loan or a negatively amortizing loan. An interest-only loan means that the borrower pays the amount of interest owed each month, but does not contribute anything toward the principal balance. A negatively amortizing loan means that the borrower pays less than the interest amount, which then increases the amount of principal that's owed on the loan. Banks will sometimes take responsibility for making payments for property taxes and homeowners insurance, which requires the borrower to contribute money to an escrow account on a monthly basis. The lender then withdraws the requisite amount from the escrow account to cover taxes and insurance when they come due. When a borrower defaults on the loan, the lender usually takes over payments for taxes and insurance in an effort to protect its security interest in the home. Let's go through the primary players in a mortgage note. The primary players are the note originator, the note holder, and the mortgage servicer. The note originator is the lender that is identified in both the mortgage note and the mortgage contract. Put simply, it's the bank that the borrower borrowed the money from. The note holder is the entity that currently owns the mortgage note and therefore has the right to enforce its terms. The note originator may be different from the current note holder because mortgage notes can be sold. They are commonly sold to banks, government-sponsored enterprises like Fannie Mae and Freddie Mac, and to investors. The entity that owns the borrower's mortgage note is the entity that has the right to foreclose. The mortgage servicer is the bank that manages the mortgage on behalf of the note owner. The servicer may be different or the same as the note holder or the note originator. For instance, Bank of America may own the mortgage note and pay another bank, Ocwen, to service the loan for it. Or Bank of America may own the loan and choose to manage it itself and therefore not pay any other entity to manage the loan. The servicer is the party that sends monthly mortgage statements to the borrower and collects mortgage payments. The servicer usually handles foreclosure on behalf of the note owner and accepts applications from borrowers wishing to lower their monthly payment through loan modifications. Essentially, all correspondence that a borrower gets from the lender is almost always going to be from the mortgage servicer. Whether borrower's financial distress arises from predatory lending or from changed financial circumstances such as the loss of a job, borrowers have options for dealing with their mortgages. Loss mitigation options are the same across the country. They are not state-specific. They should be explored with the loss mitigation department of the borrower servicer. Don't get bogged down in customer service or collections when you call the mortgage servicer. Make sure that you get to the loss mitigation department. A forbearance, which is one type of loss mitigation option, is a brief period during which the mortgage servicer allows the borrower to make low payments or allows the borrower to stop making payments. At the end of the forbearance period, the arrears have to be repaid. The servicer may require that the arrears be paid out in one lump sum or over a period of time. The type of forbearance offered will often depend on the mortgage servicer and the reason that the borrower is having difficulty making payments. For instance, a borrower who defaults due to damage to their property caused by a natural disaster, such as Superstorm Sandy, will likely be offered a different forbearance plan from a borrower who defaults due to losing their job. A loan modification changes the terms of the loan. For instance, the interest rate may be lowered and the term may be extended. Once the loan is modified, it is considered to be current, and any pending foreclosure case will be discontinued, which means that it will be withdrawn from the court. I will go over different federal loan modification programs shortly. Loan modification programs are not state-specific. A short sale is when a borrower sells their property for less than it is worth, and the lender agrees to forgive the remainder of the debt. I will discuss short sales in more detail later. A deed in lieu is when the borrower agrees to transfer the deed to the lender in exchange for the lender forgiving the debt. I will discuss deeds in lieu in more detail later as well. Bankruptcy is a federal matter that is also the same across the country. Chapter 13 deals with mortgage obligations, but requires the borrower to be able to afford a payment plan that both covers the regular monthly mortgage payments and pays down mortgage arrears. In other words, it results in a higher monthly payment than the borrower was making prior to default. Therefore, Chapter 13 will not be an option for everyone. If the mortgage servicer is unwilling to negotiate, then litigation can be used to pressure the servicer into a settlement. Most foreclosure litigation is aimed at achieving an affordable mortgage payment. When borrowers choose to litigate, the usual strategy is to assert defenses against the lender. This means that the lender brings a suit against the borrower to foreclose, and the borrower claims to have certain defenses to the foreclosure. Affirmative litigation is also a possibility, although it is more rare. This means that the borrower sues the bank. In both cases, litigation is very intensive, time-consuming, complex, and takes a long time, possibly years. In New York, residential foreclosures are Supreme Court actions. The action begins with the lender serving the borrower with a summons and complaint. The borrower should answer the summons and complaint to preserve all possible legal defenses. Shortly thereafter, the borrower should receive a notice in the mail informing them that a settlement conference has been scheduled in court. The settlement conference is usually presided over by a referee instead of a judge. A referee is a court-appointed attorney who's appointed to help mediate. An attorney for the mortgage servicer appears, and the borrower may appear with or without an attorney. This is the borrower's opportunity to try and reach a settlement with the mortgage servicer, which is usually in the form of a loan modification. If a settlement is not reached during settlement conferences, then the litigation will proceed. The mortgage servicer will attempt to foreclose, and the borrower may choose to fight the foreclosure. During settlement conferences, however, all litigation is stayed, which means neither party can file any motions. If they do file motions, the court will not address them until settlement conferences have come to an end. The modification option that I'll focus on today is known as HAMP, which stands for the Home Affordable Modification Program. Mortgage servicers that participate in HAMP are required to evaluate borrowers that apply for a modification for both HAMP and for in-house modification options. In-house modification options are just modification programs that banks offer on an individual basis. So Chase may have their own program that may differ somewhat from Bank of America's in-house program, for instance. HAMP Tier 1 is the modification program that generally offers the most favorable terms. I will discuss the difference between the HAMP Tier 1 and HAMP Tier 2 program in the next few slides. HAMP was introduced in March of 2009. At this time, over 100 mortgage servicers participate in HAMP. Just below the second bullet point on this slide, I provided a website where you can see if your servicer participates or not. The basic eligibility criteria for HAMP are as follows. The loan must be a first lien mortgage loan. The loan must have been originated before January 1st, 2009. The borrower must have a documented financial hardship. All this means is that the borrower needs to draft a letter that explains why they have trouble paying their mortgage. It could be because of an illness in the family or an illness that the borrower suffered themselves. It could be because of the loss of a job or any number of reasons. The property must not be condemned. The unpaid principal balance must be less than $729,750 for a one-unit home, $934,200 for a two-unit home, $1,129,250 for a 3-unit home, and finally $1,403,400 for a 4-unit home. The loan must secure a 1 to 4 unit property. 5-unit properties and anything larger than that are exempt. The property may be a co-op, a condo, or a manufactured home. I'd like to touch briefly on what a HAMP loan modification consists of. Basically, it's a request for mortgage assistance form, which is just an application form, the borrower's most recent income tax return, or a Form 4506T. That's an IRS form that can be downloaded online, and it gives the mortgage servicer permission to get your income taxes from the IRS. A Dodd-Frank certification, that's just a certification stating that the borrower hasn't committed certain crimes, and evidence of income. Different evidence must be provided for different types of income. I won't go through all of the different types of evidence that are required here, but just to give you a few examples. If the borrower is a wage or salary income earner, then they need to provide their 2 most recent pay stubs, which are not more than 90 calendar days old at the time of submission. The reason I say the 2 most recent pay stubs is because most people are paid either bi-weekly or semi-monthly. But if somebody is paid weekly, then they should be providing 4 pay stubs because the lender is going to want to see at least a month's worth of income. If somebody is paid just once a month, then they'll only need to provide 1 pay stub. If someone is self-employed, they're going to have to provide a profit and loss statement along with bank statements that show their self-employment income being deposited. Without these bank statements, the bank has nothing to verify the profit and loss statement with. If a borrower receives benefit income such as SSI, SSD, anything like food stamps or the Supplemental Nutrition Assistance Program, they need to provide a benefit statement and proof of receipt, such as a bank statement. Also, if a borrower has rental income, they're going to need to provide a lease to the bank, and they're also going to have to show bank statements showing that they're receiving that rental income every month. If somebody lives with the borrower who's not on the mortgage note but does contribute or could contribute a certain amount each month, they're going to need a letter from that person stating the amount that they contribute every month, and they're also going to need to prove that they're receiving that income with bank statements. A lot of clients ask me when they can expect to receive a response on their modification applications. So here I've laid out some important timelines that mortgage servicers have to comply with pursuant to Regulation X, which is a federal law. Within 5 business days following the servicer's receipt of the application, the servicer must acknowledge receipt of the application. The acknowledgement must state whether the application is complete or incomplete. If the application is incomplete, the servicer must list the additional documents and information it needs to complete the application. Within 30 days from the date that the application is complete, the servicer must review and evaluate the application. If the borrower qualifies for a modification, the servicer must send the borrower a trial period plan to give the borrower a chance to prove that they are both committed and able to making monthly payments. If the borrower does not qualify for a modification, the servicer must send a denial letter that details the reason for that denial. When mortgage servicers evaluate borrowers for loan modifications, they pass the borrower through a waterfall. The waterfall is a multiple-step process that is applied in a particular sequence, one step at a time. When evaluating a borrower for HAMP Tier 1, which offers the lowest interest rates and monthly payments, the waterfall is used to determine whether modification of one or more of the mortgage note's terms can reduce the monthly payment to 31% of the borrower's gross monthly income. 31% of a borrower's gross monthly income is considered to be an affordable monthly payment and is the goal of the HAMP Tier 1 program. The 5 steps of the waterfall, in the order in which they are applied, are capitalization of arrears, interest rate reduction, term extension, principal forbearance, and principal forgiveness. Let's go through this in some more detail. Once arrears are capitalized, the interest rate is reduced in decrements of 0.125%. If reducing the interest rate to 2% is insufficient to achieve the target payment, which again is 31% of the borrower's gross monthly income, then the next step is to extend the term. The term is extended in 1-month increments. If extension of the term to 40 years is insufficient to achieve the target payment, then the next step is to forbear principal balance, which results in a non-interest-bearing balloon payment that is due upon maturity of the loan. If the target payment cannot be achieved by forbearing 30% of the unpaid principal balance, then the mortgage servicer may decide to give part of the principal balance. However, there is nothing that requires the mortgage servicer to forgive any portion of the principal balance, and principal forgiveness is rare. Therefore, if the target payment cannot be achieved by forbearing 30% of the unpaid principal balance, then the borrower will most likely not qualify for a HAMP Tier 1 modification. Let's look at the terms of a HAMP Tier 1 modification some more. The first 5 years will be fixed at the initial interest rate needed to reach the target payment of 31%. The interest rate then slowly climbs over the next few years until it reaches the market rate at the time that the loan was modified, at which time it becomes fixed. Any forbearance amount is non-interest bearing and results in a balloon payment upon maturity. The borrower must complete a 3-month trial payment plan before the loan is permanently modified. Let's take a look at the other program I was telling you about called HAMP Tier 2. It allows homeowners to modify mortgages on non-owner occupied properties. So, in contrast to HAMP Tier 1, which is only available to borrowers who actually reside in the home, borrowers who don't reside in the home may qualify for a HAMP Tier 2 modification. So, those with investment properties and second homes. HAMP Tier 2 allows borrowers who defaulted on a HAMP Tier 1 modification to apply for HAMP Tier 2. If a borrower defaulted on HAMP Tier 1, they're no longer eligible for that type of modification again, but they may be able to apply and qualify for HAMP Tier 2. The target payment under HAMP Tier 2 may be more than or less than 31% of the borrower's gross monthly income. Interest rates are closer to market rates, which now is about 4.625%. The principal and interest payment is lowered. In contrast to HAMP Tier 1, HAMP Tier 2 does not create a target payment. Instead, it modifies the loan according to a preset process, and the purpose of the waterfall is to determine whether an acceptably affordable payment can be created. The question of whether the payment is sufficiently reduced so as to create an acceptably affordable payment is determined by the waterfall, which admittedly is pretty complex. Here's a little bit of information about how the waterfall really looks. The term can be extended to 480 months. Forbearance isn't limited to 30%. The new principal and interest payment must be at least 10% less than the old principal and interest payment. There are other waterfalls to determine whether borrowers with government-insured loans qualified for a loan modification. We don't have enough time to go over each of these in detail today. However, I do want to bring to your attention that there are 3 types of government-insured loans. These loans are insured by Fannie Mae, Freddie Mac, and FHA, the Federal Housing Administration. Fannie Mae and Freddie Mac both participate in HAMP. The waterfall used to determine whether borrowers qualify is very similar to the HAMP Tier 1 waterfall. Loans insured by Fannie and Freddie are not eligible for HAMP Tier 2, but are instead eligible for what is called a standard modification. The waterfall that is used will depend on the pre-modification loan-to-value ratio, which is just the amount owed divided by the market value of the home. The terms of these standard modification are often similar to those of HAMP Tier 2, which we discussed previously. An FHA loan is a mortgage loan that is insured by the Federal Housing Administration. Essentially, the federal government insures loans for FHA-approved lenders, which reduces the lender's risk of loss if a borrower defaults on their mortgage payments. The FHA waterfall is probably the most complicated one. Let's turn to the net present value test. The net present value test is not part of any waterfall, but it may disqualify certain borrowers from modifying their loans. The NPV test is a complicated formula that the mortgage servicer uses to weigh the costs and benefits of doing the modification. The formula determines whether it is more profitable for the lender to foreclose or to offer the borrower a modification. This can be a potential point of fudging by servicers because a lot of the values are not calculated precisely. If a servicer runs an NPV test, then they are required to provide their inputs. Some of the inputs used in their calculations are borrower's income, the amount of property taxes, homeowner's insurance, and property value. If a borrower fails the NPV test, they should challenge the inputs if they seem incorrect. They can also check whether the servicer's calculations are accurate by conducting their own NPV test using the servicer's inputs. The test can be conducted at a website called checkmynpv.com, and I've provided the URL on this slide. If a borrower qualifies for a modification under the applicable waterfall and passes the NPV test, meaning that the net present value of their property is positive, then the servicer must do the modification. Homes that are underwater, meaning that the borrower owes the lender more than the home is worth, are more likely to be NPV positive. If a borrower fails the NPV test, meaning that the net present value is negative, then the servicer may do the modification, but is not required to do so, even if the borrower qualifies for a modification pursuant to the applicable waterfall. If a borrower is denied for HAMP, then the servicer must send a written denial notice that explains the reason for the denial. If the reason is failure of the NPV test, they must tell you so and provide all of the inputs. Let's move on to short sales. A short sale is necessary when a borrower wants to sell their property but owes more money than the property is worth. The borrower must negotiate with the mortgage servicer to be released from any deficiency upon the sale of the property. The borrower must get a short sale approval letter from the lender in order to do a short sale. This constitutes proof of the lender's approval. Next, we'll discuss deeds in lieu of foreclosure. A deed in lieu of foreclosure is when a lender agrees to accept the deed to the borrower's property in exchange for forgiving the total amount of debt owed on the note. In order for a lender to agree to a deed in lieu, there cannot be any other liens, including mortgages on the property. A lien is a security interest in the property that exists until a debt is paid off. In New York, unpaid parking tickets and taxes result in liens. A borrower wishing to negotiate a deed in lieu will need to ensure that any liens are released, which requires negotiation with the lien holder. Lenders usually require the borrower to try a short sale before they will allow a deed in lieu. This is because a lender that receives the deed to a property will then have to sell the property themselves. Lenders prefer the borrowers to do this work for them. Tax and water liens can cause a home to be sold in foreclosure very quickly. Tax liens may result if a borrower does not pay their property, state, or federal taxes. Water liens may result if a borrower does not pay water and sewer charges. Borrowers should enter into payment plans to avoid foreclosure. Once a borrower receives a summons and complaint, and the summons and complaint states that the reason for foreclosure is because of some sort of tax or water lien, this is when the borrower should be calling up the attorney who is identified on the summons and complaint and tell them that they want to negotiate some sort of payment plan. If the borrower has an attorney themselves, then their attorney can call the lien holder's attorney and try and negotiate some sort of payment plan for them. Next, I'd like to turn to common legal defenses that are used in litigation in New York. A great defense is that the plaintiff or lender has failed to prove ownership of the mortgage note, which is an element of the foreclosure cause of action. This means that if it's not proven, then the lender can't foreclose. Since mortgage notes are frequently transferred to numerous banking institutions by the time foreclosure proceedings are brought, it can be difficult for the plaintiff lender to prove that the note was properly transferred to them. If they cannot effectively prove this, then they do not have the right to foreclose. Another defense is that the plaintiff lender failed to warn the homeowner that they were going to start foreclosure proceedings at least 90 days before bringing the foreclosure action. Lenders are required to do this if they wish to foreclose. Another defense which is more difficult to prove is that the plaintiff failed to act in good faith during the settlement conference process. Examples of failing to act in good faith may include failing to timely review documentation submitted by the borrower or repeatedly requesting documentation that the borrower has already provided. Note that the goal of litigation is often to pressure the bank into reaching a settlement. This is because even if the defendant wins their case and the foreclosure action is dismissed, this does not mean that they no longer owe the debt to the lender. For this reason, the lender can choose to bring a new foreclosure action against the borrower in the future. If you are having difficulty with your monthly mortgage, then beware of foreclosure rescue scams. Distressed homeowners are targeted by individuals and organizations claiming to be foreclosure and modification specialists who offer to help for an upfront fee. I sometimes meet people in clinics who tell me that they've been the victims of many scams before they had the chance to meet us. Beware of people charging upfront fees and guaranteeing results. If a borrower pays anyone, they should be sure to get a written contract that details the services they are paying for. Many services, including assistance with loss mitigation, are available for free. Housing counselors specialize in the submission of modification applications, and they are funded by the state of New York and do not charge any fees to the borrower. Be financially savvy. To the greatest extent possible, set aside money that you would otherwise be using for mortgage payments and minimize expenses. Try to negotiate with credit card companies and other companies to lower your rates and monthly payments. Contact your servicer and keep a record of all communications to and from the servicer, including who you spoke with and when you spoke with them. Keep all documents that you receive and copies of all documents that you send to the servicer. Do not rely on loss mitigation to stop foreclosure. Even if the servicer verbally assures you that foreclosure is on hold while you are being considered for loss mitigation options. If any assurances are made to you verbally, request that they be made in writing. Be sure to stay on top of the servicer until an agreement is entered into in writing. Keep an eye on your mail. Borrowers get lots of solicitations and notices from scam artists, but will also get legitimate mail from their servicer. In addition, you may get served with court papers via email, which require you to respond within a certain time frame. On this slide here, I've provided a list of free walk-in legal clinics in New York. Some of these clinics are staffed by attorneys from the New York Legal Assistance Group. Here's a list of some additional resources. You can look on ACRIS to find property records in New York City. To find a free housing counselor, you can check a website that will give you a list of free HUD certified housing counselors. You can contact the New York City Bar Association for private attorney referrals. You can find the rules that govern HAMP on the following on the websites that are provided here under the HAMP bullet point. And you can also find regulations such as Regulation X that we discussed previously on the Consumer Financial Protection Bureau's website. If you have any questions, we're here to help. To reach a NILAG attorney or a financial counselor to discuss a legal consumer protection and or financial counseling issue, please call our Chabad hotline at 212-613-6596. Again, that number is 212-613-6596. If anybody has any questions, please feel free to type them in now, and I'll address them in the order that I receive them. So I had one person ask if the information that I was providing today is equally applicable to personal loans and mortgages and business loans and mortgages. And they asked if I could provide some information on business loans. Unfortunately, New York Legal Assistance Group has a foreclosure prevention project that only specializes in residential mortgages, and we are only funded the foreclosure prevention project is only funded to help with those types of loans. So my area of expertise is not in business loans or personal loans, so I can't answer any of those questions at this time. Does anyone else have any other questions? I'll give you a few minutes to type in. Okay, so I had one person ask if I had addressed the federal Making Homes Affordable program. So yes, that was addressed in detail. So when I was talking about HAMP Tier 1 and HAMP Tier 2, HAMP stands for it's the Home Affordable Modification Program, and it's the same as Making Homes Affordable program. So all references to HAMP Tier 1 and HAMP Tier 2 addresses the Making Homes Affordable program. Any other questions? Okay, it doesn't look like anyone has any other questions, so we're gonna close the webinar. And if there are any other questions that come up, please feel free to call our hotline. Again, that number is 212-613-6596. Thank you very much for listening, and I very much hope that this webinar was helpful.